Reading 9, 2018 CFA text. Taxes and private wealth management in a global context. Taxes on investments can take three primary forms. They can be taxed on returns that are accrued and paid annually. They can be taxed on returns that are deferred until capital gains are recognized, like selling a stock. Or they can be taxed on wealth, which is accrued and paid annually. The impact of taxes on wealth accumulation compounds over time. Deferred taxes on capital gains have less impact on wealth accumulation than an annual tax obligation for the same tax rate. An investment with a cost basis below its current market value has an embedded tax liability that may reduce future after-tax accumulation. Wealth taxes apply to principal rather than to returns, and in consequence, wealth tax rates tend to be much lower than returns-based tax rates. Investments are typically subject to multiple forms of taxation. The specific exposure depends on the asset class, portfolio management style, and type of account in which it's held. An accrual equivalent tax return is the tax-free return that, if accrued annually, produces the same given after-tax accumulation. An accrual equivalent return is tax rate is annually accrued tax rate that, when applied to a pre-tax return, it produces a given after-tax accumulation. Sometimes the type of investment account overrides the tax treatment based on the asset class. Like a tax-deferred account allows tax-deductible contributions and or tax accumulation of returns, but funds are taxed when withdrawn. Tax-exempt accounts do not allow tax-deductible contributions, but allow tax-exempt accumulation of returns even when funds are withdrawn. By taxing investment returns, a taxing authority shares the investment risk with the taxpayer. As a result, the taxes can reduce investment risk. The practice of optimally placing a particular asset in a particular type of accounts is called location risk, or asset location. Tax loss harvesting defers tax liability from current to subsequent period and permits more after-tax capital to be invested in current periods. When short-term gains are taxed more heavily than the long-term, it can be difficult for short-term trading strategy to generate enough alpha to offset the higher cost and higher taxes associated with short terms. Traditional mean variance optimization can be modified to accommodate after-tax returns and after-tax risk. Otherwise, identical assets held in different types of investment accounts should be evaluated as distinct after-tax assets. An after-tax portfolio optimization model that optimizes asset allocation also optimizes asset location.